Hello and welcome to the first quarter market review and quarterly outlook. My name is Austin Fitch and we are Horizon Investments. I'm joined here today by our CIO, Scott Ladner, and we're excited to get into the content as we do on a quarterly basis, really diving into markets and diving into the economy and just trying to unpack what happened and the outlook for what we see on a go-forward basis. So I will jump to kind of the agenda that we're going to go through here today. As you'll note, we're going to be making some comparisons. We're going to be looking back historically into the mid-90s, almost 30 years ago, to get a sense for maybe some similarities that we're starting to see from the markets then and markets and economy today. So we'll talk about maybe similarities and some differences and maybe where we see things going, whether that's the economy broadly, whether that's equities specifically, or even interest rates. There are a lot of different topics that we're going to cover on today's webinar and really looking forward to diving into that content. That being said, the first piece that we will jump into from a comparison standpoint is something that we've actually talked a little bit about in previous quarters, and that's that topic of artificial intelligence. And Scott, we'll jump right in and let you kind of unpack this table for us. But before we do that, I want to make sure you highlight and give us a little bit of background behind this AI duck that we've got kind of peeking out at us in the bottom right-hand corner.
Okay, I mean, it started with the title. I had title over the slide, and then I started thinking, well, what do I do for, I'd like to make, it's just kind of a boring black and white table. Like, what else could I do with this? And then, so I just asked AI, like, this is what happens when you ask AI to create a duck. It looks like an incredibly good AI duck. I don't know. It's kind of bizarre, but I thought it was kind of clever. So I just threw it up there. Look, the point of this slide for many of you who've, maybe listened to us over the last 6 or 9 months. And this is a theme we started talking about last summer, really. And it's important. It's important because we think that the best comparison for what we think we're in the middle, like it's probably second inning of right now, is that mid-90s, middle late 90s, PC and internet boom that we got mostly in the United States. It definitely traveled around the world, but it was really centered in the US. And the reason why that was important, if we remember, and I know many of you were around then, the reason why that was primarily important is because it was a huge productivity boom. Anytime you get supply curve shifting to the right, which is really what happens with productivity booms, when you have enhancements in productivity at a company level and across industries and across sectors and across geographies, when you get that kind of movement, it is an incredibly powerful economic force, because fundamentally what it does is it creates downward pressure on inflation, and downward pressure on interest rates, and upward pressure on on GDP and growth. And so I just want to highlight here, these are some of the similarities that we think we're seeing out of this right now, and it's just as a sort of a backdrop to how you think about the world over the coming couple of years. I think it's probably a helpful comparison, and we think probably a pretty important one.
Awesome. No, Scott, I think that does a great job kind of qualitatively setting the stage for what we're going to talk about here. But maybe let's get into some of the numbers. And I think what we'll see here on this slide is, again, the 90s actually look, in a lot of cases, very similar to what we see today, whether that's stock returns, whether that's inflation, whether that's interest rates, even some GDP growth statistics. Guys, is there anything that jumps out at you that you want to make sure that we highlight as we look at some of these numbers?
Yeah, look, I think obviously there are similarities here. And it feels kind of like the 90s for those of us that were working through that period. But the higher interest rates, I don't think people remember, because it's kind of hard to remember back 25, 30 years. I don't think people remember necessarily that we did have, we experienced really strong economic growth, really strong economy with higher rates than we got right now. And I know that it feels like these rates are very high right now, and relative to the last 15, 20 years they are. But we do have historical parallels that are not that far afield, not that far back, where we had similar economic pictures in the United States and generated really, really strong equity market returns, as I'm sure everybody remembers.
No, that's a great point, Scott. And again, really want to focus on some of the similarities here. I think one thing that we also maybe want to talk about, and you touched on kind of that interest rate piece. We obviously saw a pretty severe hiking cycle there in 94 into 95. And I think what's telling, or maybe that we're looking at, is you actually had that higher for longer kind of scenario play out. And that's starting to be what we're seeing here in the 2020. So let's unpack that a little bit, both with this chart and kind of what we're seeing going forward.
Yeah, and this is similar to what we saw in the in the mid-90s. We have a really, obviously, a very fast hiking cycle, driven by the inflationary pressures we've seen over the last few years. And it is similar to what we got in the mid-90s. in 94, Greenspan embarked on this hiking cycle that he didn't tell anybody about. Like back then, they didn't tell you when they were hiking rates. You just sort of woke up one day and looked at your teller rate 3750 screen and like, oh, rates are higher. But it was, like this is this is like probably the best picture of what it can look like for longer for higher. I mean, this chart goes back 30 years, so it's that box encompasses 5 or 6 years there. But you can see a fast hiking cycle, a few cuts, like some sort of maintenance cuts, and then we hung out there for a little bit. And that's that might be the story that we're going to have here. But importantly, for the story, you didn't you even though you had a pretty quick and frankly sort of unexpected hiking cycle, you did get a recession. You didn't that hiking cycle did produce an inverted yield curves and all the same kind of things, but you didn't end up with a recession through that, and part of the reason was because of this massive productivity boom we had out of internet and PC.
No, that's a good point, Scott. And you touch on kind of internet and PC, and I think that's something that we really want to kind of dive into a little bit more, because that's, if we look at concentration when it comes to a market perspective, obviously that's something that was really relevant there mid to late 90s. You see it on this chart. We're actually looking at the largest stock relative to the 75th percentile stock across that US universe. And again, you can see in 2000s where that was right around the year 2000. You see that was almost 600 times larger, that largest stock relative to the 75th percentile. Then you see where we are today, right? Shouldn't surprise folks why people are drawing comparisons maybe to the concentration that we're seeing as we start to talk about some of those tech names, the Magnificent Seven that we've seen over the last 2 years at this point. So Scott, I think it's important that we start to really understand, okay, that maybe didn't end so well. Is that something that maybe we're looking at these similarities and should be concerning? Is that something that we should worry about? And I think this first slide in this next section maybe helps tell us that maybe it's not as much of a concern as it was 25, 30 years ago.
Yeah, look, I mean, we everybody knows that the internet, it was the internet bubble, right? I mean, that's the phraseology that we use when we describe that period. And those last couple of years were certainly like sort of a classic bubble type of formation. But that was a bubble, and that was a part of the market that was there because you had the companies that were driving the market not making any money. Like the top of the market then really didn't make a ton of money. Not the case now, guys. I mean, like the top of the market right now, these top 10 stocks, and this is just what like how much of S&P earnings are accounted for by the top 10 stocks in that index by market cap. So the biggest 10 stocks. So yeah, it's a concentrated market right now, guys. Like no big secret. There's a concentrated market based on the companies that are at the top, like earning money hand over fist, like accounting for a quarter of the profits of the entire U.S. equity market for or at least the S&P 500, which is a large part of it. And that's that's a stark and really important difference between between now and what happened back 25 years ago. Not to say we can't get another bubble formation out of what we're happening out of what's happening right now, and with all the exuberance and all the hype and everything else, but we're not there right now.
So Scott, I think one other thing, and you talked about interest rates. I think this is something that, yes, we look at rates being high currently, but you kind of hinted at something earlier that for the last 10, maybe even almost 15 years prior to when we started to see those rate hikes, we actually had pretty low rates, which has created this environment, which again is very different than the mid 90s from a sensitivity to rate changes as we look at kind of where companies sit.
Yeah, and look, you're going to hear us talk about this a couple of different ways and a couple of different times during this presentation. But part of the reason, part of the explanation for why the Fed has failed to engineer a recession thus far, and we think they'll fail to engineer a recession for the foreseeable future, is because the insensitivity of both corporations and households towards higher interest rates. Obviously, today, either with charts, we could have shown you 1,000 different charts to describe this same phenomenon. But the upshot is that companies and people don't care that much about higher interest rates because they're not paying higher interest rates on the vast majority of their debt. This just looks at short-term debt relative to total debt for companies, interest expense as a percentage of top line sales. All these things are just telling you higher interest expense at some point over the next several years will take a bite if they don't budge from here. But that day is not today.
Yeah, and Scott, you touched on the consumer, and I think this chart, and we've shown a similar chart for a couple quarters now, just talks about how consumers are actually in much better shape. Obviously, we saw a pretty serious deleveraging from a consumer standpoint coming out of 2008, right? We've talked about that time and time again. And this chart specifically looks at household debt, total household debt relative to total disposable income. So Scott, to the point that you just made from a corporate perspective, now we're looking at it from a personal perspective. And again, you see the fact that folks really aren't anywhere near out over their skis. They aren't leveraged like they were heading into kind of the early 2000s or heading into 2008. You've actually got a consumer that's in really pretty healthy shape. And I think that speaks to really an extension of exactly what you just said on the corporate side of things, which creates an environment from an economy standpoint that puts us in a pretty good spot. Now, if we maybe shift gears a little bit, I think one thing that we did see in the mid 90s, we actually had a federal budget surplus, right? We got to that point by the time you got into kind of the late 90s, but you were moving in that direction for much of the mid 90s. Scott, is it fair to say that we're probably nowhere near a surplus anytime soon?
Yeah, we don't see that on the horizon. Forecasting is a hard thing to do unless you're forecasting the federal budget deficit, and then it's not a very hard thing to do anymore. Look, this is obviously a big difference from the 90s. You know, the fiscal stance of the United States and frankly much of the rest of the world was very different, obviously, than it is today. And so it's, you know, while we don't think this is a large glaring problem today, you know, like at some point this is probably likely to matter, but like at this point it does not. I think it's actually a pretty important driver of things right now. We're going to address that later on in some other slides. But you know, this is a big difference between between the mid 90s and today. You know, this is a government that is spending money hand over fist, irrespective of who is in power.
Yeah, and Scott, you bring something up, and I want to kind of highlight that before we leave this slide. We think this could be a problem long term at some point. We just don't think it's a today problem. We actually think it may be a bit of a tailwind in the here and now. Is that fair?
That's absolutely fair.
Okay. So kind of last thing, as we look at some of the differences, I think you look at the environment from an economic competition standpoint, right? And if you look at today relative to maybe where we were, again, 30 years ago, it's a really different environment from a kind of who's leading the global economy or who's participating maybe at a higher level is maybe a better way to say it. So Scott, let's really dive into that and have that conversation, because Japan, who was obviously a pretty big player in the mid 90s, maybe is a much smaller player today, whereas China has maybe taken that lead from Japan, right?
Yeah, look, I really put this together to just to try to highlight the idea and the fact, again, if we're drawing differences from the mid 90s. In the mid 90s, the other large competitors of the United States were basically Japan and Europe writ large, but they're sort of friendly. I mean, you know, like those are economies and those are countries, those are governments that we have a generally working relationship with, and we didn't mostly mistrust. Don't think you can say the same thing about our biggest competitor today, which is still China. You know, that may not be the case in 10 years, the way they're going, but as of right now, like, you know, our biggest competitor economically is China, and you know, to call our relationship with China helpful or friendly would probably not be an accurate adjective. So, you know, hostile may be a bit strong, but it is definitely wary. And so this is definitely a stark difference from the sort of the geopolitical or sort of the global environment of the mid 90s. Again, something that we want to at least draw attention to as one of those differences.
Yeah, and I think that's a good point, Scott. I think this is definitely something we're monitoring. Maybe isn't necessarily a huge issue right here as we sit today, but something that we're aware of and definitely we have to pay attention to, right? As we maybe shift into an economic outlook a little bit, I think we'll step back into kind of some of that debt conversation. And this is something that really speaks to some of the slides we hit on earlier. Just again, we talk about the strong financial position, and I think this slide really paints a really good picture of the type of debt that is out there in the marketplace today, right? And if you actually kind of add up the different component parts, what you'll note is almost 90% of consumer debt is fixed rate, which, to Scott's point earlier, if rates have gone up, that absolutely puts pressure on folks that are having to finance things today, right? Folks that maybe are going to get a new mortgage or need to refinance for whatever reason, or maybe they have to take out a loan for a business. But if you look at folks that have already refinanced, say 5 years ago, or took advantage of the fact that rates were low for a decade, they're actually sitting in a pretty good spot. And that paints that picture of a pretty strong economy and a pretty strong consumer that we were talking about earlier. That being said, Scott, consumers don't feel good at all, right?
No.
And that's because of the inflation piece.
No, do not tell people that inflation is over. I mean, for the love of Pete, that is something that's going to draw ire from folks. And part of the reason is just because of like what we're talking about when we say inflation. When we talk about, as market pros, as everybody on this call is, when we talk about inflation, we're talking about a rate of change of something, right? And when my mom talks about inflation, she's talking about the price of something, like the price level of something. And the anchor that everybody's got in their head, as everybody in this call knows, is pre-COVID. And so, what I did is I'd like, okay, well, let's just take a look at some things that the classic grocery store items. And so, we can get some data for chicken or steak or milk or like ice. Don't make my ice cream expensive. My ice cream expensive, I'm going to be ticked off. And just track it through time and see what is the what has been the change of these things from pre-COVID until today. And it is what you think it is. The first couple of years, we had these huge price run-ups and everything, especially on the grocery aisles. But really, look, the last year and a half, those are mostly sideways. I mean, the inflation level, the inflation is not getting out of control. It is pretty well contained. It's not continuing to march higher, but those prices aren't going down. In fact, we don't want them to go down, because they go down, that means we're in a recession. But they're not going back to their pre-COVID levels. And so, the people's memories and their anchoring spot about what the price of things are is different than when economists and when market participants talk about inflation. They're talking about the rate of change of these things. But when people and consumers talk about inflation, they're talking about price levels. And so it really shouldn't come as any huge surprise why survey data that we get from people, like everybody thinks the economy is in the toilet. They're not real happy about things and everything else. But you look at their pocketbooks, you look at their checks, you look at their incomes, you look at their leverage, you look at everything else, and they're in great shape. But this is this dichotomy, this sort of difference between how they're perceiving the world, from a pre-COVID anchoring standpoint, relative to what it is now. I think does go a long way in explaining some of those frustrations that we're seeing.
Yeah, Scott, that's a great point. Again, I brought this slide up as you're talking into it. Right, this is a survey from the University of Michigan that looks at consumer sentiment, and it asks the question: do you think your financial situation is worse than it was a year ago? And you can see where we sit today. You can see where we sat, let's call it at the beginning maybe of 2022, right? Remember, at that time, folks thought they were actually worse off than they were in the depths of 2008, right? Just pause for a second and kind of think that through. That being said, we're really not that far off of that peak in terms of the pessimism level that you're seeing in folks' mind. And it goes exactly, Scott, to what you were just talking about, with the fact that prices have gone up, they haven't gone back down. And to your point, we don't necessarily expect them to go back down, but that's something that folks are going to continue to have to wrestle with as we move forward, really, to kind of as we look at an economy that hopefully continues to grow from here. That's something that we're going to have to continue to monitor, because if that pessimism starts to ratchet up again, that's maybe where you start to get some concern from a continued growth perspective. Now, that being said, we talk about kind of corporate profits and how that translates into the corporate world. And Scott, the good news is you really haven't seen a dip in profits to the extent that you've seen some of that pessimism, right?
Yeah, what's good for margins? Inflation. So why stocks do well in inflation, because it's good for margins in general. And so one thing we actually worry about on the corporate profit side is as inflation crests and comes down and sort of stabilizes and levels out to this 2-ish% range that we're starting to see. How's that gonna come through into margins? How's that gonna come through into profitability? Because obviously that has a lot to do with what the expectation for what stock market returns might look like. And one thing that we've been kind of glad to see, frankly, on the equity investment side, is that profit margins and profits really have not come down at all, even with the cresting and subsequent fall of the rate of inflation. And so what that's telling us is that we are starting to get some productivity benefits, and it probably is not from AI yet, but it's from other places. But companies are figuring out how to continue to make profits and pretty good profit margins, even in a declining or disinflationary type of environment that we've been in for the last year. This is an important thing that we're going to continue to monitor. But if we can maintain profit levels and profit margins around where they are right now, even with inflation, it's basically in the process of being whipped, that's going to end up being a really, really strong tailwind for this Goldilocks kind of market.
Yeah, and Scott, you used the word there, that I think we want to really hone in on, and that's this idea of disinflation, right? And again, we've talked about it for a couple slides now, and it's the fact that we're not expecting to see deflation. It's this fact that we're expecting to see inflation just come down. So we're calling that disinflation. And Scott, I think what we're highlighting here is really what we've gone through in the last, call it 18 months, maybe 2 years at this point, has been pretty painless in the grand scheme of things. Again, maybe not underselling some of the emotional or some of the pessimism from a sentiment standpoint. But if you actually look at maybe what happened, let's call it in the 1980s, when you kind of had that disinflationary environment, you actually saw a much different and a much more painful environment play out in that scenario.
Yeah, look, I mean, this is what all models, what all kind of grand macroeconomic models expect to happen to get inflation down is the black line. Basically the trade-off is, in order to get inflation down, I got to get unemployment up. And this comes out of a philosophy world. We could talk forever about kind of why that stuff matters. But importantly, like this cycle, like this go around, we haven't seen that. I mean, you just see the yellow line, which is this beautiful horizon yellow, just go straight down. This is painless disinflation that we're seeing right now, and that frankly is a great thing for everybody on this call.
Yeah, and Scott, I think maybe that kind of will then bring us to the conversation around, okay, so when does the Fed say, hey, we're done, right? We've gotten that inflation number back to where we need it to be, right? When can we start to think about some of those rate cuts that everybody's been talking about maybe for the last 6 to 9 months at this point? And I think what you want to hit on here is it's tied to wages, right? It's tied to wage growth.
It is, and so we're taking our cue from some of the important Fed speakers. This big block of text is from one of the Fed governors, named Waller. He's been one of the ones that have called it pretty right over the last couple of years, and so we're starting to listen to him. We have been listening to him. And essentially what he's saying is like, hey, listen, employment costs, like wages, salaries are basically the driver of companies' cost structure. And so it matters a lot for inflation what wages are doing. And so if that's the case, then you can sort of just build this sort of logical tree and say, listen, if I can figure out what wages are doing, then I may be able to figure out what inflation is doing. And one way to do that is to look at quits rates. And so there's lots of different ways you can model these things, guys. This is a pretty simple univariate type of way to do it. But just goal line is quits rates, like how many people are quitting their jobs. Obviously, at the height of the pandemic, everybody was quitting because they get paid more somewhere else. We all kind of know that anecdotally. And that's when that yellow line spikes up. That's what's happening. But that yellow line, that quits rate is coming back down more towards normal levels. And those more normal levels of quits rates of people just voluntarily getting up and leaving for a better paying job, like when that normalizes, as it is in the process of doing and pretty much has done, you usually see wages follow. And so that's what we're going to be looking for, is for wages to continue to get into this this 3 to 4% range in terms of wage growth, because that is consistent with 2% inflation from the Fed standpoint. We think we're getting there. We're probably 6 to 9 months away from being there, but we do think the path while bumpy, like, is likely to be realized in a good way.
And Scott, that last slide looked at kind of quits rates and employment costs, but maybe if we even take it a step further and look at some survey data of small businesses, it maybe tells us something similar too, right?
Yes. Look, you need to be clever and model things with math, or you can just ask me what I'm going to do. And so you just ask firms what they're going to do with wages. This is what they're telling you. Plans to raise compensation next month. It's still a little bit elevated relative to the entire history of this thing that goes back 30 years. But overall, like, we're off the boil. And importantly, off the boil for it. And if we maintain these levels that we're right now, that again is levels that are consistent with the Fed's inflation target, just to put it bluntly.
No, that's a great point, Scott. I think maybe this next slide is something that obviously kind of tiptoes into the political sphere a little bit, but I think it's something that is absolutely relevant. We've got to touch on is, we talked about the supply demand dynamic when it comes to labor, and we talked a lot about that as we went through COVID. I think what you've seen with the current administration, and just from an immigration policy perspective, is you've seen the supply side start to ramp back up over the last few years. And Scott, that's playing a pretty big role as we start to think about maybe some of the pressure that you were getting on wages because of what you had in terms of maybe a more limited workforce, right?
Yeah, and look, and part of the reason why we're getting these massive employment prints every single first Friday of the month is because we're, there are more workers than folks thought there were. There's more immigration, illegal or illegal or whatever you want to call it, like, but there are more people coming into work. And that is certainly helping some of these situations out right now.
And to be clear, Scott, we're not making any stance on whether a immigration policy is good or bad. It's just we're looking at the numbers, right? And we're seeing, hey, the supply demand dynamic has changed when it comes to the labor force, right?
You got it. Yeah, look, I mean, we do not want to let anything we think about the political environment influence how we're going to manage money in terms of like analyzing markets, and this is just what is happening.
Yep. So the other thing, Scott, that we talked a little bit about probably 3, maybe 6 months ago at this point is we were starting to see data that suggested that global central banks were stopping hiking rates, right? And maybe even some of them were starting to cut rates, right? And if we look at kind of a global short rate across all central banks, you actually start to see that play out, and you could make the argument that it's maybe starting to crest if you think about like a short-term rate across all central banks. And why that's important, Scott, is that tells us that we're probably at the top from a rate hike cycle perspective. That's not to say that we are necessarily going to get rate cuts imminently, right? We talked about the fact that we may be a little bit higher for longer, but I think we can maybe confidently or more confidently say today than we even could 6 months ago, looks like rate hikes are kind of a thing of the past as it sits today, which then kind of brings us to this last slide as we talk about rates. And it's a question of, okay, where do rates need to be? How high is too high? How low is too low? How should we be thinking about that? And Scott, I think this chart, obviously there's a lot here, so maybe kind of take a few minutes and walk us through it. But here, how should we be thinking about that?
Yeah, look, I mean, this is a question we get frequently, and frankly, it's a really good question. It's hard to answer, but I think this framework is a reasonable way to think about this. Anything too high or too low for rates is going to end up being a bad thing. Rates around where they are right now, like probably a little bit lower, like between 3% and 4% is probably really the sweet spot. But we're sitting here, with a 10-year rate of 4 and a little less than 4.5% right now. It's not the end of the world. It's probably neutral-ish. But the reason why we think this framework makes some sense is if you have 10-year rates go materially higher from here, and materially higher is like well north of 4.5%, maybe even north of 5%. Then that's really the market telling you that we have an inflation problem. It's probably not a growth thing, probably more of an inflation thing. So higher rates for inflationary reasons, obviously really bad for equity markets. Higher rates for growth reasons, a pretty good thing for equity markets. But you see 10-year north of 5%. That's probably telling you the market's sniffing out some inflationary problems that are rekindling and not good. So too high rates, not that great. Too low rates should be pretty obvious. Like you got a 10-year rate below 2.5%. That means that the market's sniffing out. We're in a pretty bad recession. That's got to cut down to zero again. They're going to start getting QE. We're going to go back to this kind of the slow growth kind of post GFC environment. That would not be a good thing for stocks either. So anything on the either extreme, frankly, for very different reasons, mean probably bad things for stocks. Mostly in the middle, probably pretty good. And we do think that we can get slightly lower rates from here in terms of 10 years. But getting much south of 4 is probably a tall order for the rest of this year. But we'll see.
And Scott, I think we call it out there on the right hand side, but that kind of green shaded area. I mean, that we've heard talk of a soft landing. What does it mean to see a soft landing? I mean, that's kind of to your point, is if we get a few rate cuts, we live somewhere between 3 and 4% from a 10-year perspective. That actually puts us in a pretty sweet spot.
It is, yeah. I mean, look, that's the market saying inflation is not a big problem, but growth is reasonably healthy. Like, guess what? That's a good recipe for stocks.
Yep, absolutely. Now, and you talk about a recipe for stocks, and we'll close with a section kind of on stocks specifically. And Scott, one thing maybe we haven't talked a lot about, definitely today, but even more recently, has been small caps. And I think that's one area where if you actually started to get some rate cuts or just some relief in that space, actually may be a positive for small caps relative to other areas of the market.
Yeah, look, I mean, small caps. So the reason why the rate relief would be good for small caps is because small caps are generally more indebted than large caps are. And not only are they more indebted, but they're indebted with generally short-term rates or floating rate loans or shorter term debt. And so, so higher rates just have a larger impact on small caps relative to large caps in sort of a macro sense. And so, when rates really rose, over the last couple of years, that's a pretty big headwind for small cap performance. But just as it was a pretty big headwind for small cap performance, we get rates dropping again, and we get, or even just like the idea that, hey, listen, the top's definitely in, and we're gonna, we're probably, within a 50 basis point range from here. That actually be a pretty strong tailwind for small caps. So, in order to get really bullish on small caps, we are going to need to see rates, like definitively peak, have the Fed start to cut, and probably have rates come down some. But that, they can benefit, from rates going down, just like they got creamed by rates going up.
Yeah, that's a good point, Scott. So one thing we haven't talked a lot about, and maybe sometimes, Scott, right, is fiscal policy, right? I think we wanted to bring this up, and again, maybe it's a little bit of a non sequitur here, but if you're looking at it, right, fiscal policy could end up being a really important component as we look out into the next 2-3 years, right?
Yeah, it could. And look, the reason why this is in the equity section rather than the sort of the economy section is because the tie-in is pretty clean. Like the government spending a lot of money and incurring all this debt. Yes, it is certainly boosting the economy. I could have put it in there, but we chose to put it in here because this idea of fiscal dominance is something that you probably hear us talk about in the coming quarters. It could be an important topic that I don't think too many people are talking about just yet. But it's just the idea that the Treasury and fiscal side can be probably more important on a relative basis than the monetary policy on a go-forward basis when you have high fiscal deficits like we do right now. But so understanding that dynamic is something that you'll probably hear us talk a little bit more about coming up. But we want to at least introduce the concept to you on this call and say, listen, this is something we think bears watching. And so long as the government continues to spend money like this, I'm not going to say it's great for the next 30 years, but it probably is pretty good for the next 3.
So Scott, we've talked a lot about kind of the stocks broadly, but if we really unpack some of the fundamentals, I think this is an important slide to really kind of look beneath the hood a little bit, to look at earnings and try and get a sense of where we stand from a earnings recession or recovery standpoint. I think the good news, Scott, is what we see here is we're full blown into that recovery mode at this point. Yes, I think the statement can be made that there absolutely was an earnings recession there in late 22, early 2023 that we all lived through. We can make the argument that we were in a recession, not in a recession broadly for lots of different reasons. But I think you can pretty clearly make the argument that we were in an earnings recession. But the good news is that we're, as you can see on the right-hand side, we're well past that at this point. And what you're seeing is really a pretty positive outlook. And Scott, then that goes into maybe earnings estimates as we're looking at the market more broadly. And this is where it maybe starts to get interesting because you see a pretty wide divergence depending on the segment of the market that you're looking at. Scott, is that right?
Yeah, look, and this is this is coming through in performance. We all know the small caps have had a pretty tough run for most of the last year or two. With last November, December notwithstanding. For the most part, they've had a pretty tough run. And it's not part of the reason because they're more interest rate sensitive. Part of the reason too is because they're not earning as much money. The large caps, and especially the large caps that we talked about earlier, are just killing it. And so, in terms of like relative performance on the earnings side, on the company fundamental side, large caps are outperforming small caps on the fundamental side, and that is reflecting in performance. This is something we think is probably likely to continue for a bit, but this is definitely on our radar. One of those things that we're watching pretty closely.
So, Scott, the last couple slides that we have here will really get into the conversation around kind of that inverted yield curve and what that means in terms of a recessionary predictor and what that means for stocks, right? And I think this chart, or this slide, I should say, with 2 charts kind of allows us to dive into it in a couple different fashions. One looks at the kind of the depth of the inversion of the yield curve, and 2 looks at maybe the length. And Scott, I think maybe help us look at whether or not either of these, both of these, really is or should be a good predictor of recession.
Yeah, look, we were all inundated with pieces and calls and like everything, like, hey, like yield curve is inverted, so ergo recession is going to be terrible for buy gold and bricks and whatever else. And that lasted for a while, and it's lasted for a couple of years now. Like, so not only was this inversion of the yield curve pretty deep, but like right now, like we're the longest right now. Like this yield curve has been inverted for any time longer than since frankly I've been alive. And so that is a like this is, if you want to talk about a yield curve being a good predictor of recession, I will point to the last couple 3 years as being the counter example of that, because it's been a terrible. It's because we have not gotten a recession obviously, and we're not likely to get one right now. And so that ends up being like a very important thing, because we got inundated with all the calls about, hey, we're inverted yield curve, therefore terrible things to come, fire, brimstone, everything else. I promise you, the next things you're going to start seeing is when the yield curve uninverts. Then you get all those same folks that were out there telling you that the yield curve meant death and destruction, yield curve meant death and destruction. They're going to come out and say, no, really, it's the yield when it uninverts. That's when really the pain gets felt. Like that's when the trouble comes. Like when it uninverts, like that's when it happens. It's not like it's so this is a chart. So this is what happens to the stock market. So I think it's the S&P 500 specifically after the yield curve uninverts. And so under two scenarios. Scenario one is that ugly Duke blue is what happens when you have a recession and the yield curve uninverts. And the gorgeous Carolina blue that you see there is what happens to the stock market after yield curve uninverts when there's no recession. So Carolina blue, no recession. Duke blue, recession. Like really, this comes down to are you going to get a recession? Like the yield curve uninverting is going to have nothing to do with whether or not you have good stock market returns. So please ignore those messages, those research notes when you get them, and just like think about, are we getting a recession or not? If you get that part right, you get the stock market call right.
Scott, I just want to hear how many times you can say uninvert and think that through without your brain turn into a pretzel.
Yeah, none more times. That's it.
Awesome. No, this has been super helpful, really, to dive into all the different kind of areas that we're looking at. Hopefully, these takeaways that we've listed here are helpful as you're kind of thinking back through. But we have had a number of questions come across in the last few days that we want to make sure that we highlighted as we wrapped up today. And Scott, we briefly touched on it a little bit. We kind of tiptoed around it in certain places, but 2024 is an election year. And sadly, that means, we've got to talk about it. We're probably going to talk even more about it as we get into kind of the summer and fall months. But we always say that, election is probably less impactful than most people think, but we definitely have two pretty polarizing candidates in 2024. And what are we seeing in terms of an impact from a market standpoint? What are we seeing from a volatility standpoint? Anything that we would add there?
So, but from a volatility standpoint, you probably will see some, especially as we lead up into it. You might see some more if it's contested one way or the other. From a what's going to happen to the economy, broadly speaking, and which is really going to drive what's really going to drive like what's happening with stock and bond markets. We don't see a huge change coming out of this. The reason why we don't see a huge change is because neither one of these candidates really want to change the fiscal path. So if you want to think about like a big picture kind of stuff, how much the government spends is a big picture kind of thing. There's not stark differences between, there's difference between what they want to spend money on, but the amount of money they want to spend is roughly the same. And so like that's driving some of this view in terms of like it's not likely to matter that much. Look, we might end up changing our minds through this. We're still pretty early, but as we see it right now, like in terms of the policies that have been laid out and what we think the likely activity of either candidate if they should get into office, we don't see a really large impact on either stock or bond markets right now.
So Scott, maybe kind of tangentially related, we talked a little bit about rate cuts and the possibility of higher for longer. But as we maybe relate it to the political conversation that obviously will be happening this year, do we think at any point this year, kind of the rate cut conversation becomes political? It becomes a conversation from one side of the aisle to the other?
Yeah, it probably does. Look, and that's somewhat unfortunate, but it's also reality. And so we don't want to hide or run from reality, even though it might be uncomfortable and not what we want. And so the fact of the matter is, like as we approach the election, as you get into like October, especially, what the Fed does is going to be viewed through a political lens, and I don't think it'll be that. I don't think they're going to act with political motives that much. But it'll be viewed that way, and so I do think that impacts how they're thinking about June and July in terms of trying to get off the schneid for rate cuts. But like we'll probably have further thoughts on that as we get closer into the summer. But yeah, I think that there's definitely a possibility that the Fed is going to be viewed as more of a political institution than it probably is in reality.
So one other question around rate cuts, and as maybe it ties into inflation, is just kind of how volatile do we think inflation is going to be? Do we think that that's going to be something that we're going to be dealing with? Maybe inflation, 2, 3, 4%, just kind of up, down, not necessarily kind of that normal inflation of 1 to 1.5% that we got used to. Do we think inflation volatility is something that becomes a bit more normal as we head into 2024 and beyond?
Yeah, this is a really smart question because I think the answer is yes, but it's not necessarily yes for the reasons that you might think. It's probably likely to be yes because the drivers of inflation are going to be more volatile, and by the drivers I mean one of the big drivers is like how volatile is GDP and how volatile is nominal growth. And if you enter in a higher growth environment, that growth is likely to just be more naturally volatile. So, whereas, if a line that starts up here is likely more volatile than a line that starts down here and does like this. We've been down here doing this thing for a little while, and, with kind of low growth and low volatility about that growth, which is one way to be. But if we're heading back into this mid-90s realm, where we're going to have higher nominal GDP growth with that probably coupled with a little bit higher inflation, that higher nominal GDP growth is probably going to come with a little bit more volatility around inflation. Now, we don't think it's going to be massively more volatile, but I don't think we're going to get an environment like we've seen in the last 15 years, where prior to COVID, where inflation was basically zero volatility.
Awesome. No, so Scott, last maybe question that we continue to get, and it's I think pretty timely and definitely relevant because we actually didn't have any slides in the deck today on this, but what's our view on internationals, right? Do we think internationals are forever dead? Do we think there will be a time when internationals offer some benefits, some diversification? Like, what's the thought there, given the fact that they have been beaten down so bad over the last, at this point, shoot, it's been a decade, right?
Yeah, look, I mean, I think there's some pretty smart, compelling cases for some international markets right now. Like Europe is not a market that we've been in love with very much over the last 5 years. But we do think their central bank, the ECB, is likely to cut rates more aggressively and probably faster, and maybe even sooner than the Fed. And the European economy is much more geared towards interest rates than the U.S. is, so that's likely to have a larger impact. The ECB's rate cuts might have a larger impact on their economy than the Fed rate cuts will have on our economy. And so that's more cyclical nature of the European economy. That can make that pretty interesting because they're darn cheap right now. Japan's another area that we've liked. Out of all the international areas in the world, Japan is where we've had our largest overweight. We continue to have it as a pretty good overweight, and we think we probably will for a bit because they're undergoing their own sort of a new normal in terms of their nominal growth. They're having a new generation of leaders there. They care more about profits. They're getting wage increases. They're getting some animal spirits back in that economy. They're getting some risk taking back in that economy. Really for the first time in about 25, 30 years. So Japan continues to be a pretty interesting place, we think. But emerging markets, and especially places like China, we think there'll be pockets of opportunity to invest. But you really got to pick your spots. That's probably not long term right now in terms of what's going on, especially in places like China. But we do think there'll be times and places. We just don't think it's right now.
Awesome. No, good insight, Scott. Really appreciate the time today, and really appreciate everybody joining us. Again, if you have any additional questions, please don't hesitate to reach out to our team, whether that's a regional director, whether that's our internal desk, or if you have a strategist that you're working with on our consulting team. We'd love to talk to you, have those further discussions, and continue the conversation. As always, we appreciate the partnership, and we really appreciate the business. Look forward to talking to everybody soon. Thanks so much, and we'll see you soon.